Since it's now 2 p.m. in Sri Lanka, let's proceed with the webinar. Ladies and gentlemen and dignitaries, it's wish you a very good afternoon or a very good morning, depending on where you are joining from. I am Chaya Disanayaka, and it's my pleasure to welcome you to this today's webinar on behalf of the Institute of Policy Studies of Sri Lanka. This webinar focuses on the economic effects of the recent US tariff changes on South Asia and the wider global economy. And we have three panelists, Dr. Asanka Vijayasinghe, a research fellow here at IPS, and Professor Selim Raihan from the South Asian Network of Economic Modeling. And then Dr. Barun Depal from International Food Policy Research Institute. And we have two discussants, Ms. Mahnoor Arshad from Sustainable Development Policy Institute and Mr. Ravishankar Sanju and from South Asia Watch on Trade, Economics and Environment. So each panelist will discuss about their studies focusing on their own economies, and then the two discussants will discuss further about the global implications and societal implications for South Asia. Without further ado, I would like to invite Dr. Asanka Vijayasinghe, the first panelist, to give a brief overview of the today's webinar and then proceed to his presentation on Sri Lanka's economy. Dr. Asanka Vijayasinghe is a research fellow at the Institute of Policy Studies of Sri Lanka, specializing in international trade, regional integration, and industrial policy. His work examines the impact of trade policies on food security, household welfare, and global value chain participation. Over to you, Dr. Asanka.
Thanks, Chaya. I warmly welcome everyone for this webinar. Let me briefly explain the content of my presentation. Mainly, this new trade system is called as Turnberry system by the US trade representative. It is a new development we have to face. And some methodological notes, especially on how we can model this tariff, how we did the tariff modeling. And then I will discuss the counterfactual experiments and the results. So this was the most kind of discussed op-ed written by USTR, United States Trade Representative. They called it as a new global order. So what are the features of this new global order? They, especially US, is using tariff as the formidable stick, and they give the market access to the US. Which they call world's most lucrative consumer market. Then we all know that in WTO or GATT's mechanism, we had a dispute settlement body, but in this system, kind of pushed forward by the US, there is no such dispute settlement body. Instead of that, tariff is considered as a credible threat to obtain the commitment. So Turnberry is the place where EU and the US agreed on the trade deal. They had 15% tariff for EU and some concession for the US. So we have discussed about what were the drivers of these US protectionist measures. There were various theories from import competition from low-wage countries, especially popularized by Otto et al., and localized labor market, again, by the same authors. And there were political economic kind of explanations, especially coming from a political science discipline. Economic rules and conservative grievances caused these protectionist measures. And again, the revival of Trump policies, especially his election victory, is attributed to Biden era inflation or seller inflation. However, we saw that consistent move by the US towards this protectionist measures even after 2020 election. Well, what is South Asia's exposure to US? This is the most important fact because all of these tariff changes and the impact, then the spillover impact on labor market and everything depends on overall exposure. You can see that US share is highest among the countries Sri Lanka, Pakistan, and India. That means the share as total exports to the world. When it comes to the sectoral exposure, again, India, Sri Lanka, and Pakistan had significant exposure in sectors like wear and apparel. The key exports by the South Asian countries, which are low-tech manufacturing products. When it comes to Sri Lanka, it is about 37 to 40%. It depends on the base year we use for the calculation. You can see in Pakistan, it is 30.5 in wear and apparel. Bangladesh has less exposure when it comes to wear and apparel with 14.5%. However, as a sector, wear and apparel from Bangladesh is the highest export sector because of the high concentration. And this shows the change of base rate. Base rate is the 2024 base rate we calculated using USA ITC data. And the August rate before US imposed 25% on India, but all the other rates as announced by 31st July. So you can see most of the countries are seeing very high tariff jump in their effective tariff rate, overall effective tariff rate faced in the US. For example, Sri Lanka, it is 29.95 now from 10.21. And from Bangladesh, it is 35.19 from 15.24. Again, India, it is like 19.08 before this 50% application. So what is the tariff exposure of India after 50%? You can see a large jump in the tariff, especially sectors like food products, textiles, and wear and apparel. However, some sectors which have a significant contribution to India's exports, like basic pharmaceuticals, they are not seeing a huge jump because these products are exempted from reciprocal tariff. So the key focus of this webinar is to discuss what are the export, labor market, and macroeconomic effects of this increased tariff on South Asian countries, drawing evidence from different South Asian countries. And also, you can see this tariff schedule is individualized. The tariff is scheduled for each country. Then there is a differential tariff advantage or disadvantage, which can cause trade dilution. So whether we want to discuss whether there are such benefits coming out of this for some countries at the expense of the other countries. Another important thing is what is the impact of this tariff on dynamic gains on trade? Because we can see that in the new equilibrium after this tariff shock, the economic structure can change, and that change will determine the future growth of the South Asian countries. There were positive spillover effect of trade, poverty alleviation, women empowerment, providing employment for low skilled and also female workers. So how does the new US enforced tariff system affect the rules-based trade system binded by GATT and later WTO? And what is the impact on South Asia's growth prospects? So most of the studies we will discuss here they will be based on computable general equilibrium modeling work. Why we need such a modeling framework? Because one thing is the shock is large and it is a global shock. It is not individual sector-wise or country-wise shock. Then this spillover effects can be substantial to the factor markets like labor, land, and capital. Then the structural changes to the economy can be identified using this kind of modeling exercise. Other important thing is that adjustments through price of factors can happen when there is a reduction in exports and the demand for the factors go down. As a result of that, factor prices can change. This in turn can affect the competitiveness of the countries. In general equilibrium modeling, we can factor all of these input-output linkages. So this can be considered as the most appropriate model for the impact evaluation. However, there are large data issues when we try to estimate. One thing is the current tariff landscape is very complex. There are reciprocal tariff, that is the focus of most of the discussions, like 25, 20, or 50. But there are sectional tariffs, especially for steel, aluminium, copper, and some investigations are going on. And country-specific additional tariffs are also there. Brazil 40%, India 25%. And some of the products are exempted from this country-specific tariff. Like, for example, Brazil has a long list of this kind of products. And there are deals which modify these tariffs, like the most popular and discussed deals like EU, US, Japan, US deals. Another issue is there are some retaliation, and also Trade War 1, which happened in 2018, there was some developments, especially bilateral tariffs between China and the US. So it is important to factor in all of these things to accurately calculate the impact. So you can see the new effective rate for wearing apparel. You can see India has a very high rate with the 50% now. China has 51%. Bangladesh 36.4%. You can see individual countries have relative price difference now that can create trade diversion too. And some countries are in a beneficial position, especially like Mexico, Honduras, and some EU countries. Mexico is in advantage because of the USMCA agreement with the US. Again, when it comes to rubber products, the same pattern you can see. Canada and Mexico, they are producing manufactured rubber, importing raw materials, then manufacture final products. So this tariff rise is not even uniform across countries. Because of the exemptions and sectoral tariff, the tariff change is vastly different. For example, in Sri Lanka, you can see the non-ferrous metal products, for example, these are under Section 232 tariff, 50%. The effective rate is 56.9%. But other minerals, you can see effective rate has not gone up that much because key exports like graphite are exempted from tariff. So what we did was we used JITA version 11, and but there is a problem in that because 2017 is the base year. After 2017, a lot of things happened. US-China trade war and relative economic sizes also changed. For example, Sri Lanka's economy contracted in this period. And productive factor quantities change. Also, there were bilateral tariff changes through FTAs. So the first thing we did was we built a model, 48 sectors, 36 regions. We took South Asian countries separately when there is a separate country in GTAP database, and all the other major economies separately. So this gives us a flexible enough framework to shock country-specific US tariffs and deals also. Another thing we did was, so these are the sectors. One important thing we did was we updated the database from 2017 to 2024. So the first set of simulation were actually constructing the baseline. We shocked the model for real GDP, labor, population, and also change tariff, US tariff on China and China tariff on US to factor in trade war one measures. My guess is if you don't do that, the current tariff impact can be overestimated. So tariff changes at sector country pair level, we change using the forward-looking tariff data set of ITC. And Sri Lanka tariff we updated using Sri Lanka Customs, so more reliable data. So data-wise, base rates were calculated using US ITC import data on HTS US 8 and 10 digit, and then we calculate the effective rate by sector. So the first thing we did was modeling current effective rate, that's Sri Lanka 20%. The scenario is like this: Brazil has 50, India has 50, all the other countries rates as announced on July 31st, 2025. So the effective tariff rates include all the sectoral tariff exemptions and the deals proposed by the US and the trade partners. And retaliation-wise, China and Canada, their announced retaliatory measures are. So this is the real GDP impact of this scenario for selected countries. US in the standard closure, in not the unemployment closure. This is the standard closure. You can see US is US real GDP could go down by negative 436, and the impact on India of this 50% can be negative 0.03, and some countries, especially Bangladesh and Sri Lanka, can realize a small positive effect coming out of this. I will explain how this can be the case. So now you can see real GDP effect under unemployment closure. Unemployment closure, we assume that wages are rigid. As a result of that unemployment, there are quantitative adjustments. Unemployment is in the model. Generally, we can see that the negative impact can be more pronounced in this kind of cases because now there are productive factors idle. Again, US impact is about negative 1.46. For India, it is 0.226 negative effect. Again, the other countries gain some, and Bangladesh has a slight negative impact. So you can see an alternative policy scenario when there is 25%, Sri Lanka's GDP could go down, actually. The impact could be negative. So what happened with 50 is some trade diversion in sectors like ready-made garments happened. And also Sri Lanka highly rely on India's raw material. So when the factor prices go down in the US, it is generating a positive impact for countries like Sri Lanka. However, this real GDP impact is not the case. This is anyway a static model. We are estimating not dynamic model. So you can see the export effect of these two scenarios, India 25% versus Sri Lanka versus India 50%. This is the change of wearing apparel exports to the US. If India has 25%, Sri Lanka could expect 12.23% negative impact on Sri Lanka's wearing apparel exports to the US. But when India has 50%, you can see it is 2 percentage points less. It is because of this trade dilution. Almost all the countries realize such trade dilution in this model in South Asia. However, India will face a drastic reduction of their ready-made garment wearing apparel exports if there will be 50%. So what we did was we used these model estimates, and then we got labor force survey data from Sri Lanka for 2023 and calculated possible labor market impact. So now you can see the largest labor market effect is on wearing apparel sector, about 13,700. And the majority of these workers are unskilled workers. Please note that when the gender dimension is considered, 71% of Sri Lanka's ready-made wearing apparel labor force workforce are represented by female workers. So this is India's 25 case. You can see Sri Lanka's impact could be a bit more, especially labor force contraction in wearing apparel could be about 16,000. Okay, so what is happening to the overall economic structure? So you can see most of the industrial exports of Sri Lanka, industrial sectors and export-oriented sectors are contracting as a result of the US tariffs. The growing sectors are mostly agriculture. That means the labor force and the resources when after the economic shock will be absorbed by these sectors and then grow. Okay, this shows one important thing. This is the change of US overall demand on different sectors. Mainly, you can see wearing apparel sector import demand from the US will go down 9.53%. What I want to show is, so we are talking about trade diversion and everything, but this is a large shock for each country. So overall price level will go up. As a result of that, US demand for products should go down. So trade diversion impact can moderate some of the effect, but still, due to the plunge in the demand, our countries can be affected. And mainly, you can see rubber products demand will go down by about 17%, textile 23.26%, like that. So key takeaways. Real GDP shock as one-time shock on the baseline might be manageable for our country. However, adverse effects on the industrial sector can create some dynamic losses in the long run. And mainly output and labor demand contraction can happen in these more important sectors which produce formal employment and mostly export-oriented. The contraction of export-oriented sectors, especially wearing apparel, can reverse most of the sustainable development gains, mainly affecting the women and low-skilled workers. Again, I want to focus your attention on what will happen to the dynamic gains of trade when the economy move from more export-oriented economy to agriculture and service-based domestic-oriented economy due to this external tariff rise. That will reduce our country's growth potential in the long run. So immediate impact might not be the problem. Maybe sustain the long-term dynamic growth effects can be the real problem of these tariffs. So we did a simulation to see what Sri Lanka actually can do. So we can, of course, remove some tariff on the US as a concession, but our simulations show that at 20%, it might not generate much of gain for Sri Lanka, but real GDP impact can be further negative. Not only that, some of the sectors, especially agricultural sectors, can face import competition. So this is the overview to the webinar and also our Sri Lanka experience, evidence from Sri Lanka. So as Sri Lanka, we have a strong incentive for further negotiation and bringing down the tariff rate further. But we should note that tariff negotiations are generally reciprocal. Sri Lanka also will have to give something. Then we should be careful about the import competition impact, especially the domestic consumption-oriented sectors like dairy and meat. Then the other impact is other measures Sri Lanka should focus is be proactive on what is happening in the other market, especially EU, European Union deforestation regulation. Regulation can affect Sri Lanka's rubber exports significantly, for example. So things should be done to make sure Sri Lanka comply with this growing regulation. Thank you very much. Over to you, Chayana.
Thank you, Dr. Asanka. Next up is the presentation by Professor Selim Raihan on economic effects on Bangladesh. Professor Selim is a professor of economics at the University of Dhaka and the executive director of SANEM, South Asian Network on Economic Modeling, with over 25 years of teaching and research experience in trade, poverty, labor markets, and macroeconomic policy. He serves on the board of Global Development Network and has collaborated extensively with leading international organizations. Over to you, Professor Raihan.
Thank you very much. I hope I'm audible.
Yes, you are perfectly audible.
Okay, thank you. I think Asanka made a very, I think, excellent presentation, and that also gives me kind of a strong background of my presentation because we use the same model, the GTAP model. So here I'm going to present to you the focus is on Bangladesh, but definitely since the model also incorporates some other countries, so I'll also talk about other impact on other countries. So if you look at the background of the study and the kind of context, Bangladesh is of course at a very crucial crossroads, and we know the kind of political transition which took place in 2024. There are many challenges, especially both in economic and political fronts. The country is also graduating from LDC in November 2026. And then we see these very evolving global and regional trade and geopolitical landscapes. And these pose very, I think, the major challenges to the country's economic security. So, of course, as Asanka very rightly kind of elaborated, that these Trump tariffs and associated global uncertainties, they have important implications for South Asian countries, and Bangladesh is no exception. So what I did, like Asanka, almost a similar process. We use the GTAP model, and which has got 160 countries, 65 sectors with the base year 2017. But like Asanka also did some pre-simulations to reflect the more recent base year, especially to 24, as Asanka nicely explained. Between 2017 and 2024, many things happened. So we tried to incorporate those and did this pre-simulation to update the database. And we know that the GTAP database, it includes bilateral trade flows, applied tariffs, input-output relationships, and factor endowments, enabling consistent modeling of global trade dynamics. So that is the kind of one of the best available tools which are available, which the modelers or trade economists can use to capture the impacts of these kind of scenarios, especially related to the trade wars or Trump's reciprocal tariffs. So here my aggregation was relatively smaller and it had a bit of different perspective. But again, Bangladesh and India, these two countries are there from South Asia. But you can see some countries like Malaysia is there. But US, China is of course the two, they are two important countries. And then you have South Africa, Japan, Indonesia. Vietnam, and also European Union, then you have almost 150 countries which kind of combined as the rest of the world in this model. So in the simulation, we shopped on the import tariff variable, and we used the tariff rate, reciprocal tariff rate as of August 7, 2025. So this is the data, this is the link to the reciprocal tariff rate. So the challenge was because we have these around 10 countries, individual countries, but then all the rest of the countries are grouped into the rest of the world, then how do you get a weighted average reciprocal tariff rate? So what we did, we used the weights of individual countries, and there's of those 150 countries, their export to US, and use those weight to calculate the import weighted reciprocal tariff for this particular aggregated rest of the world. So for these 151 countries. And we also kind of consider the standard GDP standard closures. I did not really go for the unemployment closure as shown by Asanka, but also did some sensitivity analysis to conduct the to check the robustness. So these are the reciprocal tariff rates, as I said earlier, from the link, the August 7 the updates. But as we also know that these are changing, and these we don't know that in future how many of them will remain, and also there are some exemptions. So we also took into account some of the sectoral exemptions for different countries and some of the deals which are also taking place. So in the case of indicators for analysis, we looked at the real GDP changes, welfare changes, impact on the bilateral trade flows, sectoral output and employment impact, and the balance of trade. So in general, we see that the impacts on Bangladesh kind of small, positive, as also was shown in Asanka's presentation. It's very small. And then you can see that Vietnam is also kind of not affected. But the negative impacts on USA and China is kind of visible. So, which is consistent with kind of the scenario and the kind of expectation that this is going to have negative impact on USA as well. It's not only for just 1 second. What is that? Yeah. So not only it's not a kind of win-win situation. So that's kind of thing what we kind of try to get from this analysis. I don't know why I'm having a problem. Okay, so here also, what is also appearing in terms of welfare, if you just see that the equivalent variation, the small welfare gain for Bangladesh, and then you can do the decomposition in terms of allocative efficiency or terms of trade, little bit of terms of trade, because as is shown in Asanka's analysis, there will be some kind of shifting of trade. Some countries will gain above other countries because of some tariff differences. But for Bangladesh, there will be investment savings, negative investment savings effect emanating from the negative impact on certain export-oriented sectors, because there would not be investment going into those sectors. New investment would not be going into those sectors. So this is also, and we see that for India, there is a kind of large negative welfare gain or welfare loss for India. I just want to highlight this very interesting findings which comes from the model, is that globally, there would be some negative impact on the prices, which would actually drive the exporting countries to gain, to have negative impact on their exports. For Bangladesh, I'm not really taking you through all the prices, but the most important prices are these textile and wearing apparels for these two sectors, because you know that for Bangladesh, more than around 85% of its exports are actually considered in textile and wearing apparels, what we call ready-made garments. And you see that there the global prices would actually fall. The export prices would fall for these two categories. But for many other export products where Sri Lanka or South Asian countries, they have keen interest, they will also experience fall in their export prices. Now, looking at the impact on total export to the US. If that happens, because since I use a standard closer, consider a kind of a period of longer time horizon, where the factors can move easily from one sector to another, and then you reach an equilibrium where the factors are perfectly mobile and they can actually be allocated to all sectors. So you see that there are some significant impact on exports, negative impact on exports while exporting to the US. Bangladesh's total export to US is likely to decline by around 15.5%. India definitely is going to be a big sufferer in this case. And this is generating, of course, the high tariffs, which is restricting, making the export less competitive. And at the same time, the contraction of demand in the US market, that is also leading to fall in import. And that is also affecting many of these countries. Now, in particular, I think since, as I mentioned earlier, that Bangladesh's export to US and in the total export baskets, more than 80% or 85, around 85% is ready-made garments. So the textile and clothing export would decline under this scenario if these tariff rates prevail by 8% to the US market. But you can see that for India, it's huge, around 80%, I think, which is consistent with the results generated by Asanka showed in this presentation. So in general, this is the output effect, the sectoral output effect in Bangladesh, and that shows that in general, most of the manufacturing sectors, they would suffer, and in particular, textile and wearing apparels, they will experience negative impact. But there would be some reallocation from moving from the manufacturing to some agriculture sector, where you will see some expansion. But that is because of the reallocation. But in general, as I showed earlier, the GDP impact is very small. So overall, there is nothing to be excited that with this very small GDP positive impact that Bangladesh is likely to gain. And it's really not the case, because in general, we're seeing that whatever number is generating, and what that is also shown in Asanka's presentation, there's a very small rise in GDP that is just coming out because of some reallocation of factors moving from manufacturing to agriculture. And similarly, in the case of employment also, we see that the similar pattern would be observed. And especially, I would just like to highlight these two sectors where there's textile and wearing apparel, where there would be some significant fall in employment, which is consistent with the fall in export and output in these two sectors. In general, also, it shows that Bangladesh is also going to experience a fall in its balance of trade. Especially all these numbers shows negative. India is, of course, negative as well, larger negative. But it shows that this situation is going to have, as we're seeing, the export is falling at the same, but in the case of Bangladesh and some other countries as well, import would not that fall much, so which would lead to further deterioration of the balance of trade. Now, coming to, I think, the more important analytical perspective of this whole issues. Because what Asanka has shown and my simulations, they are kind of consistent to each other. And the results are appearing that countries in South Asia, they would be affected, even if they gain, but the gains would be very small. And some countries will actually suffer more than others. But I would really ask some fundamental questions, especially when it comes to implications for Trump's tariff. Because we know there are three fundamental questions in international trade, especially with respect to the pattern of trade. And when we talk about the pattern of trade, we talk about comparative advantage, which has a very strong footing in the discussion of international trade, in the literature or theory of international trade. But there are also, we use the theories of new trade theories or intra-industry trade to explain the pattern of trade. Second question is how much to trade, especially over, how much the country would impose restrictions when it comes to trading with each other. And third one, who gains from trade. So these are the three fundamental questions. I think course 101 in trade, international trade, will definitely tell the students. But we see that Trump's tariff have important implications for all these three questions, especially when it comes to a rules-based trading system where the WTO and GATT and eventually WTO, which emerged, and they tried to focus on these three particular questions and moving towards more freer trade regime based on comparative advantage, lowering the restrictions on trading with each other, and also try to ensure ensure a system where countries can gain from trade. I think this is under serious question or serious threat. So what we are seeing, moving from a rules-based trading system to a more what we call a deals-based trading system, where USA or Trump administration is making deals with different countries, and the countries who are in a better position to make deals, they are likely to evade the negative consequences of these very global uncertainties. So I think here comes the negotiating power of the countries, the kind of leverage a country can use while making deals with the Trump administration. And countries like Bangladesh, definitely they are not in a stronger position in doing so. So I think those kind of discussions need to be taken into account while we analyze these implications of Trump's tariff. However, the sustainability of Trump tariffs is also an issue. Whether this will continue, whether USA, the kind of negative impact is likely to happen within their own economy, with the contraction of demand, with the rise in prices in the domestic market, whether this can continue. And we have seen some of the symptoms already that in the court, High Court also, this has been challenged. And there is a verdict also we have seen. So I think one question which Asanka mentioned in his concept note, that what is the future of the export-led growth model? Whether this is gone, there is no future for a country like Bangladesh or Sri Lanka to rely on the export-led growth model. My opinion would be that I think despite all these uncertainties, countries like Bangladesh and Sri Lanka, they don't have any other option not to go for export-led growth model, because the domestic market in Bangladesh, of course, is bigger than Sri Lanka, but the domestic market, when it comes to the per capita income, is still very small, and you can't have a sophisticated or solid or robust growth model based only on the domestic economy. I think still that the importance of growth, export-led growth model is valid. So this is my final slide. So what should Bangladesh do? I see there are 5 strategies, and which can also be, I think, important or applicable for other countries in South Asia. So responding to global protectionism, and what you've seen, that simulation highlights the urgent need to recalibrate the trade strategies. Countries like Bangladesh, I think, are still struggling to recalibrate its trade strategies because it is still using its old import and export policies or FTA policies. So we need to recalibrate. The second is diversification as a core strategy, especially for Bangladesh. As I mentioned earlier, the export basket is highly concentrated, and also the export market is also very concentrated. So there is a need to move away from those concentrated basket and market to more diversified ones. Revitalizing the trade agreements, especially Bangladesh has not been successful in pursuing FTAs. So there's an important area which need to be explored. Embedding economic resilience by building institutional strength, diversified trade networks, and adapting adaptive industrial policy to withstand external shocks and geopolitical spillovers. And finally, future-proofing trade capacity. So develop early warning systems, bolster SME export readiness, invest in logistics and infrastructure where the country is seriously lagging, and align trade planning with sustainability goals. I'll stop here, and many thanks for listening to me.
Thank you, Dr. Raihan. Now we invite Dr. Barun Depal to talk about the economic impacts on India. Dr. Depal is a research coordinator at the International Food Policy Research Institute, IFRI, with expertise in climate change, agricultural development, and economic modeling. He has over a decade of research experience in climate-smart agriculture and land use planning, with a strong background in CGE and macroeconomic modeling. Over to you, Dr. Depal.
Thank you. Thank you for your invitation. I hope you can hear me.
Yes, very clearly.
Yeah, thank you. And you can see my screen as well.
Yes, we can.
Thank you once again, and good afternoon to everyone who joined from different parts of the South Asian countries as well as from this world. Already, Dr. Ashanka and Professor Salim Rayhan talked about the South Asian economy, including India. So they have briefly given overview about Indian economy, its consequences of the US tariff. So my presentation will focus more specific to the country that I'm living now, in India, and we'll discuss more detail about how this Trump tariff will impact Indian economy. Only difference that we'll have in our analysis, we'll be using country-specific computer general equilibrium model apart from the global model that our previous speaker have already discussed about. So already I think we have discussed about the context why we are here. So I am not repeating the motivation for this particular study, because it's quite obvious reason why we are here in this particular webinar. So I am skipping that motivation, so and straight away jump to the trade profile of India, between India and US. So I think most of these issues already been discussed, but to give you more detailed perspective for the Indian trade with US. So if you look at the Indian trade data from UN Comtrade in 2022, India exported almost 54 billion US dollar worth export to United States, and which is basically the 20% of India's export to US. And the top 10 commodities that we listed in this particular table that constitute almost 45 billion US dollar of 54 billion US dollars. That means these 10 commodities are highly sensitive commodities that are exposed with the United States market. And of this top 10 commodities, three most important commodities are textile, that basically 38% of textile export that we ship to US, followed by seafood and seafood processing, that is 36% of that export goes to US, and other manufacturing that includes small equipment, watches, and some kind of gems, jewelry, and others. And apart from that, we have other like clothing, electrical equipment, and chemicals products. These are highly exportable commodities from India to US. So it shows that the India and US, we had a strong partnership in terms of the India's export to US. On the other hand, in US is also a significant partner for India's import. So total 30.7 billion US dollar worth in merchandise import India had in 2022, which is almost 7.4% of India's merchandise import from US. And the top 10 commodities, together they contribute around 28 billion US dollar import from US. So among these top 10 commodities, if we look at the paper and paper product, that is around 17.8% of total import comes from US, followed by motor vehicles, and the largest one is the other manufacturing. So now if we look at the tariff structure and the structure of the trade, India export largely on manufacturing product to US. Like total export India sent to US is around 98 to 99% is manufacturing, whereas US export to India is 60% manufacturing and 37% mining, followed by some amount from agriculture sector. That is 3% US export to India, whereas India's export to US is only 1%. The most, I think insightful information is the difference in the tariff rate that India imposes on the import from US, and on the other hand, US impose tariff on India's product or enter into the US border. So if you look at the graph on the right side, India imposes around 32.4% tariff on the product comes from the US. In contrast, US imposed 3.2% for agricultural commodities. And similar way, we can see the manufacturing sector, India imposes around 30% as compared to 5% that US imposed. So that may be the reason or motivation that US new administration or the Trump tariff concept came, and they were severely impacting the India and impose almost 50% tariff. There are other theories also working in the US economy, and there are a lot of discussions going on. But this was the first, I think, initial step to move towards this, imposing higher tariff on Indian commodity. So now, having said that or given this background, what is our objective in this particular work is to do a rapid assessment using an economy-wide framework. I think the model that already we discussed, and my previous speakers already discussed about the computable general equilibrium model. This is basically an economy-wide model where we capture not only one particular sector, but the group of sectors, including the international trade and government and the household. So in this particular study, we are not only measuring the impact on Indian economy, but on the other hand, we are also trying to assess what India should do if, or what will happen to Indian economy if India retaliate with the tariff, or in other words, we can say that if India engage with trade oil like China or other countries. So in this particular case, we are using IFRI's dynamic CG model. With our base year is 2022-23, but we solved it until 2030 and wanted to see what will be the average consequences on the economic indicators. So when we estimated the shock on the model, so when we measured the shock on the export, we have assumed that when US impose higher tariff on Indian product goes to US, that means that Indian exporters will lose some amount of revenue from the export market that they send to US. So in our model, it's a single country model, unlike GTAP global model that is a multiple country, but it's our single country model. We assume world price of export for particular products are fixed, and we adjust that product according to the amount of tariff that US imposed and the share of India's export to US. Same way, on the other hand, when we consider the import tariff concession that India can offer, or if India impose higher tariff, then it will definitely increase the tariff rate that India impose at the Indian border when commodity comes from the US. So using the share of US in India's import, we adjust the tariff rate that India can impose under different scenarios. So in this particular model, we are assuming that government savings and exchange rates are flexible. Government savings are flexible. Basically, government will adjust its fiscal deficit to stabilize the economy. It can borrow more fund if there is any to meet the social security benefits or to ensure the other government commitments to the economy. On the other hand, since it is a closed economy, and we are assuming that the exchange rate will adjust the external account or current account balance for this country. And in this model, we are assuming unskilled labor are unemployed, whereas full employment for the skilled worker. And the capital is fully employed, but activity specific. So capital is not mobile across the sectors. And the database that we are using, it's a social accounting matrix data that our institution, International Food Policy Research Institute, they have developed for the year 2022-23 using the National Account Statistics published by Government of India. And in this particular time, we have 87 sector of which 34 sectors are agriculture, 41 industry, and 12 other services. And in this SAM, we have 15 household sector. They are classified into three categories: rural farm household, rural non-farm household, and urban households. And further, the households are categorized in terms of their per capita expenditure quantile. So we split the household at the national level in quantile, and each quantile then further split into three categories: rural farm, rural non-farm, and urban households. And 13 factor of production we have considered in this SAM and this model. One is the land that largely used as a primary factor input for agriculture sector. Then four types of capital: crop, live animals, mining, and other financial capital. And eight types of labor categorized in terms of their education level. So the labor that the less educated are called unskilled labor, and the highly educated labor are called the high skilled labor. So this is the way we split the labor market in this model. Now, there are three scenarios we have considered in this particular model. First scenario is quite straightforward, that if US imposes higher tariff on India, ranging from 5 to 50 percentage point over the baseline, we considered the 5% because the study when we did that time, the discussion was that US will impose a tariff. And we were anticipating that the tariff may go up to 50%. And suddenly we have seen that the 50% tariff has been imposed, and I think from last week onward it is operational now. The second step we have assumed, second scenario, that if India reciprocate with the similar amount of tariff, then what will happen to the Indian economy? Or is it a good option for India to retaliate? And third option is that if India can take a preemptive assumption to offer tariff concession, provided if US does not impose any additional tariff on India. So whether that can be an option, because if India remove the tariff, then obviously there will be less revenue to the government, but we don't know, there will be other positive implications may happen to the economy. So that is why we thought of having these three scenarios together. Now, before I explain the results, let us understand the economics behind this tariff. So there are two cases here. One case is the US imposes tariff on Indian export. Another case is that India offers tariff concession. So when we say US imposes tariff, there are two counter scenario we develop. One is that India will not reciprocate, and another is that India will reciprocate. So that's basically the second step when the country is responding to this particular shock. Then there's an impact channel, how this shock is how this shock is impacting the economy, and rather I would say the spillover effect, how that spillover effect will have impact on the macroeconomic indicators. So what happens when there is a higher tariff that US impose? So India's export will fall. I think already our some presentations by Professor Selim and Asanka, they have already described that India's export will fall. And when export falls, the foreign currency earning will be less, and then you need more amount of dollar to buy the import. So now, so what happens? The foreign currency demand rises to pay the import bill, so your currency will depreciate, and that already we are observing in the current Indian market as well. And when your country currency depreciate, your import becomes costly, and the production sectors, or the manufacturing or even service or agriculture sector, the imported input they use, that will become more costly. So domestic production will also become costly at the same time. So it's not that only export fall will have the tariff that US impose will have impact on the export fall. There will be spillover effect on the domestic economy through the channel of depreciation of rupees as well as the costly import. On the other hand, if India retaliates, given that US is imposing higher tariffs, then import will become more costly, and that due to higher tariffs. So that will have another negative consequences on the domestic production sectors. And as a result, we can see that some sectors will have bad effect of this tariff, or negatively impact of this higher tariff, even in both the cases of retaliation and there's no retaliation. However, there can be some sectors which get benefit from this tariff war, and as a result of reduction in output or fall in output, there will be fall in employment, and there will be issue of income inequality, or household income will also fall. On the other hand, if India offers tariff concession, then there will be no US tariff. If, this is the condition that if US does not, this is like a negotiation between India and US. If that happens, we don't know what will happen in the future, but if that happens, then what happens? That there will be more demand for import, because import will be cheaper in the Indian market and lower domestic cost of production, because the industry that uses imported input, so their cost of production will be less, and so India can earn another competitive advantage in the export market as well. And so we can find a steady state kind of a situation where there will be no further negative consequences on the Indian economy if India offers the tariff. So let us look at the results. So here we have assumed a range of tariff options that US could impose, but we'll focus more on the 50% because which is now reality. So if you look at the 50% tariff scenario, on the left hand side, impact on Indian export. So Indian export will fall by 2% on average due to this 50% tariff. This is an aggregate import, and on the aggregate Indian export. On the other hand, Indian import will fall more. So because because of the rupee depreciation, and we can say it's like a macroeconomic effect. But the only one interesting fact is that your import fall will be more than your export fall. So then you can say we can understand that there will be a lot of foreign currency reserve happen in the economy, but it does not happen that way, because at the same time your domestic production will also fall, and the higher and costly import will push the cost of production up, and as a result we can see there is an impact, a negative impact on the GDP. And in our model, we measure that almost 0.46% GDP percentage the fall in India's GDP due to 50% imposition of tariff by US. Whereas if India retaliate, then this negative impact will further exaggerate, and it can reach to 0.62%, because that will lead to more costly import, further depreciation of the currency, domestic production will fall, unemployment will create. So as a result, you will have a more negative impact on the GDP. In contrast, if India took the preemptive action of relaxing tariff or give some kind of a concession, then there will be some kind of a positive implications, not very significantly, but at least some positive effect, or that's what we said, the steady state economic situation we can achieve by offering tariff concession. Now, there are a group of sectors that will be highly vulnerable, and those are textile, wholesale, retail, trade, construction, machineries, manufacturing. Those I think we have already described in the previous slides, that these sectors, these are highly exposed with US market for their export. They will be highly affected because of this 50% tariff. But then, if we look at this textile and clothing sector, their contribution to the your economy is 1.6% of India's GDP they contribute. So, but on the other hand, if you look at the hotel and food services, financial services, that they will be the gainer in this particular trade or in this particular tariff scenario. Whereas financial service, they contribute 22.2% of the GDP. So there is a way out for India to escape from this tariff impact. One is that to find the service sector avenue to export more, and to mitigate some amount of negative effect that India could foresee because of the negative effect on the manufacturing and textile and other merchandise export due to the higher tariff. Now, in case of employment, if we see, there will be 0.88% fall in employment in aggregate in India, corresponding to 50% tariff, and provided India does not retaliate. But if India retaliates, the employment fall will be further. And if you look at the household income, the bottom 60% household income, there will fall in around 1.9%, whereas top 40%, the relatively rich people, their income will be 1.21% fall due to 50% US tariff. So basically, the relatively low income households, they are endowed with a largely unskilled worker, and since the rise in unemployment and because of the negative consequences on the manufacturing sector, the income of the bottom household will be more affected than the rich household, that we can see from this figure, that 1.9% is the bottom household, bottom 60% of the household, and top 40% household will have a negative effect of 1.21%. So what we observed from this particular study, we found that US tariff hikes will harm Indian trade and other macro indicators, GDP. And we have seen that since trade with US accounts almost 11% of India's overall trade, including export and import, India is relatively exposed and significantly more vulnerable to the trade policy shock that US. So there is uh, no further evidence is required that India is highly vulnerable and India is going to get a negative effect because of this 50% tariff, because of the higher dependency of India's export to US. The reciprocity will have a negative impact on the Indian economy. So India must not go with the retaliatory measures. It will have more negative consequences on the economy. Tariff concession could mitigate the harm, but the real challenge would be to offer tariff concession to a particular country, because this can lose India's strategic advantage with the other countries as well. So it is very risky strategy. So we have to find a way out through the bilateral negotiation. India should find alternative avenues, that export diversification, that in our country also exports are also in India should find the alternative avenues to escape the negative effect of US in a higher tariff for the Indian products. However, in the long run, we need to develop strategy and investment plan to strengthen our domestic industries through technical innovation, so that we can have a better efficiency and competitive and advantage of Indian product and Indian industries, so that we can mitigate such kind of, or we can make our economy more resilient for such kind of a tariff shock or any kind of a geopolitical shock to the country. So the major caveats for our study is that our country, we use country level CG model rather than a global model that my previous speakers already mentioned. So generally global models are more suitable for assessing global trade impact, because we could capture the trade diversification issues. Maybe because of that, our GDP impact is higher than the GTAP model result that Professor Salim and Ashanka mentioned, because in our model we fail to capture that trade diversification effect, whereas the global model can capture it better. But the overall, the dimension or the direction of the results quite similar to what we observed from the global model. And our model is designed for short-term analysis. We took a 5 years period to see what will happen, because in the 5 years down the line, and estimate the average impact. However, it does not provide insight in the long-run bilateral trade relationships between India and US. So, but the things are changing over time, and geopolitics is a dynamic issue. So we'll hope to see and hope to work more on this issue in the future. With these words, I thank you, everyone, and over to you.
Thank you, Dr. Devpal. Then we it's the turn for the discussion. The first discussant is Ms. Mahnur Arshad on the gendered impact of these tariffs on South Asian women and men. Ms. Mahnur Arshad is a research associate at the Sustainable Development Policy Institute, SDPI, working on gender equality, financial inclusion, trade, energy, and governance. She had led studies on women's empowerment and digital transformation, and actively engages in policy advocacy and development partnerships in Pakistan. Over to you, Ms. Nasha.
Thank you very much. I'll just take 2 minutes to share my screen. Hope my presentation is visible.
Not yet. Yes, it is now.
Okay, perfect. Right. So my presentation today is going to be about the economic effects of US tariffs on Pakistan from a gender lens. So firstly, I'll be talking about just giving you all a brief overview of Trump tariffs and how Pakistan is touched by them, whether directly or indirectly. So firstly, we have the section 2 in quite detail by previous speakers. So I'll just briefly go through them. Now, these under this section, the moves that were made were essentially to keep these duties salient for any Pakistan origin steel or aluminium items, and for Pakistani firms that import these inputs for processing in global value chains. Secondly, of course, are the also famous broader reciprocal tariffs, which essentially are part of a wider strategy to raise duties across many partners in response to large US trade deficits. This, of course, creates an across-the-board risk environment for all exporters to the US, Pakistan being no exception, of course. Thirdly is the US generalized scheme of preferences. Pakistan has historically benefited from US GSP for non-textile products. After periodic lapses and renewals of this GSP by Congress, Pakistan again shows up in recent Business Council assessments as a top 10 beneficiary when the program is active. But the coverage again matters mostly for non-apparel lines. This means that most of Pakistan's top exports to the US, including home textiles and garments, face the normal most favored nation tariffs. And in recent protectionist measures do become candidates for additional surcharges. Okay, so fourthly, I was talking about macro confidence and investments. So heightened policy uncertainty, especially where US tariffs can vary any day. This affects exporting firms' capital spending, their workforce planning, and their willingness to enter long-term contracts. So for Pakistan, already contending with high energy costs and financing constraints, there's additional uncertainty from a top market, which can slow down investment in productivity upgrades. So next, I'll talk about essentially when we're talking about this trade milieu. Of course, it's affected as a whole, but who bears the brunt domestically, and why women are disproportionately exposed in this case. So first, if I just talk about the female labor force, Pakistan's export engine is primarily based on textiles and apparel, sports goods, surgical instruments, and women are disproportionately represented in low-wage segments of these value chains. First one, if I talk about textiles and apparel, Pakistan's top US export categories fall here. But since they're GSP ineligible and already face non-trivial most favored nation rates, a US tariff hike or stricter enforcement environment raises procurement risks for US buyers. If orders, they shift to other regions, women in stitching and finishing units are among the first to see hours cut or contracts not renewed as firms respond with flexible labor adjustments. It's important to state here that several credible sources state that textiles employ a large share of Pakistan's workforce, approximately somewhere between 38 to 45%, with women composing of a significant share of that employment. The broader reality of the matter is that female labor force participation remains low nationally, somewhere between 21 to 24% due to a number of reasons. So any shock concentrated in textiles will have a major gendered effect. So I was talking about the female labor force, and essentially women in Pakistan, they're clustered in export exposed sectors at the lowest rungs of the value chain, and more usually, on casual and informal contracts. So when orders drop, these are the roles that are impacted first. Moving forward, I will now talk about women-led SMEs and women in trade. So women-owned SMEs in Pakistan already they navigate credit gaps, collateral constraints, and then limited networks also, and then their compliance capacity issues as well. There was a diagnostic study by the Central Bank of Pakistan, and it has confirmed that women's businesses remain small, thinly capitalized, and under-networked, which are traits that magnify exposure to tariff-induced volatility. So tariffs do exacerbate 4 pre-existing frictions for women-led SMEs and women in trade. So firstly is the cash flow problem. US buyers, they may demand price concessions or longer payment terms to offset higher landed costs. So this requires lines of credit that many women-led firms cannot readily access at affordable rates. Secondly, there's compliance and certification fixed costs. When margins tighten, US buyers consolidate to fewer suppliers who can show robust compliance. So the fixed cost of maintaining such certifications, and the management attention that something like this demands, hits small women-led exporters the hardest, and then it pushes them out of higher value orders even when they produce acceptable quality. Shifting the exports towards markets where Pakistan enjoys preferences such as the EU GSP Plus is a plausible option, but then buyer development cycles are long and product specifications can differ. So it'll be a greater challenge for women-led SMEs to pivot quickly. Fourthly is the documentation complexity. When tariff lines change or when country or product exemptions are in a flux, paperwork does increase, and women-led businesses are more prone to face error risks in HS classification and then preface claims also. And these errors can then be very costly when it comes to US customs. So overall, how big could the macroeconomic effect be? Tariffs are bound to reduce export volumes and compress margins. On the plus side, though, in the case of Pakistan, the tariffs on Pakistani goods are at 19%, which is lower than others in the region. Although this is a big opportunity, but what is the use of access without the needed ability, right? And why do I say this? Because there are several compounding factors inside Pakistan which can amplify a US tariff shock. Firstly is the energy price volatility. Electricity is currently at 17.5 cents per kilowatt hours, which is double that of Vietnam and Bangladesh. When it comes to gas, we're at $15 per million metric British thermal unit, which is about 2 times more. And then there's in the region, and then there's currency swings and interest rates amounting to about in the range of 70 to 22%. So, if fewer dollars come in from the US, working capital tightens, the rupee path grows more uncertain, and imported inputs become more expensive. This will have a trickle effect, and this macro feedback loop will hit labor-intensive exports fastest, again, where many women are concentrated. And if I just talk about the specific impacts on women, there's employment and earnings. When it comes to employment and earnings, short hours and casual contracts means that women experience income volatility rather than immediate layoffs, which means reduced overtime can cut monthly take home by double-digit percentages. Secondly, hiring freezes also reduces the number of entry-level opportunities for young women wanting to enter into stitching and merchandising roles. When it comes to SME survivability, women-led micro and small exporters, when it comes to embellishment, handicrafts, leather accessories, and other niche homeware, they rely on a handful of US boutiques and online retailers. So when a tariff-induced order drop from one anchor buyer comes in, it can break the entire business model for them. In supply chains where women provide home-based services, order reduction transmits quickly into household income shocks with very limited social protection cushions for them. So to maintain competitiveness under high tariffs, firms must differentiate and innovate, and these upgrades require essential steps such as capital expenditure and know-how with regards to several aspects such as compliance documentation. Women-led SMEs who are already facing credit and mentorship gaps risk being stuck in low-value segments. Lastly, I'll be talking about what can be some practical policy and business responses going forward. When it comes to government to government and trade diplomacy, it's essential that both the government can take up targeted advocacy on tariff relief and exclusions. Secondly, make the case on GSP adjacent opportunities. Even though textiles and apparel are largely GSP ineligible, Pakistan can pursue pilot programs or value-added accumulation ideas for non-apparel lines with high women participation. For example, carpets, certain leather accessories, so on and so forth. Secondly, domestic competitiveness and social protection. So firstly, gender smart export finance needs to be taken up. There's a need to scale a dedicated export working capital window for women-led SMEs that ties cheaper credit to verified participation and export orders to shock-proof payrolls when US buyers stretch payment terms. Secondly, it's important to take into consideration compliance as a service. Create pooled audit, certification, and traceability services in major clusters, such as in Lahore, Faisalabad, Sialkot, so that small women-led firms can rent compliance capabilities at a fraction of the fixed cost. Then there's skills and occupational mobility. It's very important to invest in upskilling that moves women from low-wage stitching to higher-wage technical roles, which will automatically reduce the concentration of women in the most shock-prone activities. Then there's household level resilience that needs to be focused on. When export downturns, they cut earnings, cash transfer, top-ups, or utility bill relief can be temporarily targeted to women workers or who are present on the factory rosters. And thereby ensuring that the benefit reaches the worker, not only a certain household head. Next, I'll be talking about the firm level strategies, especially with focus on women-led SMEs. So first of all, product upgrading and niche positioning. There's no second thought about it. There's a need to escape pure price competition by moving towards functional home textiles, traceable leather, for example, or value-added sports products. And channel diversification, of course, which other speakers before me have also talked about, while preserving the much needed relationship with the US, it's important to look into other markets also. So there's the EU GSP Plus for textiles, which can absorb some volume if designs are adapted according to their requirements. Then there's the GCC, the Gulf region, and East Asia for mid-price apparel and sports goods. And of course, e-commerce platforms for craft and home accessories. Lastly, I'd like to emphasize, and I say this with great emphasis because there's a huge challenge when it comes to data with regards to women, whether in the labor force or in the trade space or the business environment. There's a great need for monitoring indicators to track impact on women, and this is essential for evidence-informed, gender-responsive policy making. With that, I'd like to end my presentation and thank you to all for listening and for your patience despite the connectivity issues that I faced earlier. Thank you.
We can move on to the next discussant, Mr. Ravi Shankar Sainchu, on implications on Nepal and the future of South Asia's export-led growth in a disintegrated world. Mr. Ravishankar Sanju is the Vice Chair of South Asia Watch on Trade, Economics and Environment, Saudi, and the former Joint Secretary of Nepal's Ministry of Industry, Commerce and Supplies. With over 3 decades of experience in trade negotiations, economic policy, and infrastructure development, he has represented Nepal in key bilateral and regional trade talks and contributed significantly to policy and institutional reforms.
Thank you very much for inviting me in this discussion program. I have not prepared any slides for that, so I will just, based on the previous presentation made by the panelists, I will focus on implications for Nepal. Thank you to my fellow panelists for their highly excellent presentations. I offer my warm greetings and namaste. The new US tariff policy has had an uniform effect across the South Asia. It has created a completely differential trade landscape that fundamentally challenged the traditional export-led growth model of our neighbor. It seems that this disparity creates a profound opportunity for Nepal on one of the tariff arbitrage in increasingly fragmented world market. The president of the Garment Producer Association of Nepal has expressed optimism that if this tariff holds, our garment export to the US could increase 50 to 100% fold in the coming years. But this perception is slightly misleading. I feel so. However, This opportunity is double-edged sword. It is predicted on a new US trade policy that is legally challenged and fundamentally unpredictable. Furthermore, Nepal's deep economic interdependence with India exposes it to a substantial spillover risks, including potential inflation and increased cost for raw materials import. The most immediate and critical threat is the risk of illegal transshipment, where the foreign goods are routed through the Nepal to evade the tariff. Such an activity, if not decisively curbed, could lead to severe penalties from the United States, jeopardizing the very trade relationship Nepal seeks to strengthen. For Nepal, this moment is about a relative tariff advantages. It's about being caught in the crossfire of a global economic paradigm shift. We are witnessing the collapse of the predictable rule-based multilateral system and its replacement with a fragmented, power-driven model of bilateral and sectorally specific protectionism. In this new reality, the very foundation of South Asia's export-led growth model, which Nepal has been striving to imitate, is under threat. I'll focus on the profound implication for Nepal and the collective challenge this presents to our region. The direct impact of US tariff on Nepal's import is minimal. The real threat is complex, systematic, and highlighting our core vulnerabilities as a landlocked, least developed countries. The theory that global buyers will shift order from Dhaka or Delhi to Kathmandu due to the tariff differential ignores the ground realities of modern supply chain. Buyers' priorities is scale, reliability, speed, and compliance. Nepal's manufacturing sectors lack the deft infrastructure and capacity to absorb the diverted demand at a competitive scale and space. Our landlocked status imposes a permanent logistic tax, comprising higher transportation costs, longer lead times, and bureaucratic delays at the border. A hypothetical 10% tariff saving is instantly negated by 15 to 20% advantages is eroded by not by tariff, but by geography and infrastructure deficit. Nepal economy is deeply integrated with India's to the open border, a currency peg, and immense trade dependency. A significant economic shocks to India triggered by its tariff will inevitably spill over into Nepal. This contingent could manifest reduction in Indian investment in Nepal, contraction in the demand for Nepalese export in our primary market, pressure on Nepalese rupees due to its peg to the Indian rupees, and potential slowdown in the remittance flow from Nepali working in India. The US policy specifically targeted gateway sectors like low-tech manufacturing. This sends a powerful deterrent signal to the investor. Why should a foreign direct investor commit capital to build a garment factory in Nepal, a sector we are desperately trying to grow, when the largest export market can alter access conditions overnight based on not on rules but political discretion? This doesn't just impact existing export, it suffocates potential export also and sabotages our industrial policy before it can bear fruits. The export-led growth is central to our job creation. For Nepal, this is not an economic theory, but a pathway out of poverty. The apparels and garment sector is a critical formal employer of the women. By chilling investment in these policies directly undermine the women's economic empowerment and our national goal and for a poverty reduction also. We are not just losing market, we are also losing the generation of opportunity for a socio-economic transformation. The US shift toward a unilateral and a transitory system represents an existential threat to the South Asian growth model, which has relied on integrating into a global value chain. The fragmentation of high-tech value chain, like, for example, like electronics, effectively shuts down the opportunities for the South Asian countries to join the manufacturing value chain. This is a devastating long-term blow. It means countries like Nepal are not only locked out of their current comparative advantages sector, that is textile, but are also being denied to opportunities to climb the technological ladder and move into the more advanced, high-value industries. The ladder is being pulled up just as we are trying to place our foot on the first rung. Another is the WS system provides a stable, predictable framework. Erosion means trade will be governed by a complex web of overlapping and often contradictory bilateral deals, a spaghetti ball of rules of origin and standard. For a small economy like Nepal, navigating this chaos is administratively and financially impossible. It creates immense transaction cost and legal uncertainties, making a strategy of global integration prohibitively complex and risky. This crisis must be a wake-up call. The old model of competing against each other for a favor in a single large market is dying. Our future resilience depends on regional cooperation. We must urgently breathe life into the South Asian free trade area, SAFTA, reducing non-tariff barriers and fostering regional value chain. Can Nepal yarn be used by Bangladesh government for export? Can Indian components be assembled in Sri Lanka or Nepal? We can no longer be overly reliant on any single market. This is a moment to aggressively pursue trade agreements with other blocs like EU, UK, and ASEAN, and to diversify our export basket towards the service and niche and high-value goods, where logistic costs are a smaller factor. In conclusion, the increased US tariff are a symptom of a broader disease, the disintegration of global trade governance. For Nepal, this is not an opportunity, but multifaceted threat that exposes our structural fatalities and jeopardize our development structure. Therefore, our response must be equally strategic and manifested. Nepal must treat this as an urgent call to address its internal constraints, logistics, energy, governance, to enhance its inherent competitiveness, irrespective of external tariff regime. Regionally, we must abandon the futile game of relative advantages. Our collective survival depends on it. We must forge a cohesive South Asian bloc that can negotiate collectively and build resilient regional supply chain less vulnerable to our external shock. Globally, we must add to our voice to defend and reform the multilateral rules-based system. It remains the best defense of a small nation against the trinity of economic power politics. The export-led growth model is not dead, but its architecture must be changed. It must be built on regional integration, diversification, and a relentless internal reform. The alternative is to remain perpetually on the sideline, vulnerable to the whims of disintegrated world. Thank you.
And thank you once again to all the panelists and the two discussants for the most valuable information and the insights you shared. Now it's time for the Q&A and discussion. And I have one question directed to us, to Dr. Asanka, from Professor Naufal Wilkasim from the London School of Economics. What assumption did you make about the pass-through rate to the end consumers in the US to tariff on garments in Sri Lanka? And afterwards, if other participants have any questions, you can ask them in chat and the panelists will answer your questions. Thank you. Over to you, Dr.
Yeah, so special assumption, so changes were not made to the model on the pass-through. So my guess is the model assumes 100% pass-through. The literature in the first trade war, it shows close to 100% pass-through, but first trade war was very limited in sectors, but this is a very broad pass-through, broad tariff shock, and right now in surveys, we can find that some producers are absorbing the cost. So that means pass-through might not be 100. So the model is not capturing that aspect. So it is a caveat in the model. If we assume less than 100 pass-through, then the demand effect can be less than this. However, there might be some other effects, like, for example, margin contraction can affect the technology use. There can be cost-saving strategies by the producers. So, there is no change to the model in the pass-through one. About the alternative markets, I have seen this in the discussions a lot. However, we need to identify that South Asian countries produce low-tech manufacturing products. Generally, the demand is coming from developed countries like US and the EU. Then alternative markets, actually, they are our competitors. For example, African countries, they are also ambitious about producing ready-made garments. And East Asian countries, some of the countries still producing ready-made garments, and they have very high tariff on ready-made garments. Regionally, our trade agreements are also a bit weak. For example, the India-Sri Lanka Free Trade Agreement, there is a quota for 8 million pieces of ready-made garments. So these things need to be changed if we are going for alternative markets. The other thing is, with this product basket, it might not be able to find alternative market. So diversification along the product lines is also an option here. Yeah, about this pass-through, I'm not exactly sure. Maybe Professor Raihan has a comment. And the Barron's model, I don't know how this pass-through assumption is taken into.
No, I don't have any further comments, Asanka. I think you explained it very nicely. Thank you.
Yeah, thanks.
We don't see any more questions on chat. Are there any questions from panelists towards each other, or from the discussants towards the panelists? So it seems that there are no questions then. So thank you once again for participating in this event, and let me ask Dr. Asanka Vijayasinghe to formally thank you and close the session. Dr. Asanka?
Yeah, first of all, I want to thank all the resource person, including the discussant, who spent like 2 hours. And I know this work, like putting this into a presentation, is also a very tough task, given the various calculations we had to make, especially effective rates and stuff, everything. I thank Dr. Barun, Professor Salim, Ms. Arshad, and Mr. Abhishankar Sanju. Most of these notices were actually within like 1 week. So thank you very much for agreeing with such a short notice. We will make this available in YouTube, the recording, and share with you. And thank you very much for participation in this.